Well, good morning, everybody, and welcome to the webinar for today, Pre-Trend Trade Patterns that every trader should know. What I'd like to do is run through a quick bit of housekeeping, just a few disclaimers, and then we'll get on with the show. But I do want to welcome everybody and those that are coming into the room right now. Glad you could join us today. So again, we're just going to get a few bits of housekeeping out of the way, and then we'll get started with the show. Good morning, Joe. Glad you're here. So the first is the risk disclaimer stating that trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors because the high degree of leverage can work against you as well as for you. And next, the hypothetical performance slide stating past performance is not indicative of future results. The session today is going to focus on pre-trend patterns, and these are going to work across all time frames regardless of your preference, whether you are a day trader, a swing trader, position trader. These patterns can be very helpful for you if you know how to recognize them, how to recognize the end of those patterns and the continuation or the start of a new trend. So we'll be discussing those as well. Should you wish to reach out, you have my email address and my Twitter handle there. Don't hesitate to reach out to me. We'd be happy to take any questions you have that aren't covered in the Q&A section after today's webinar. So here's today's big idea. Now, the pre-trend patterns that we're going to take a look at is going to be under the umbrella, if you will, of Elliot Wave. Now, you don't have to be a top-notch Elliotician to understand this, because they really are just clean patterns disrupting the overall trend. Now, yes, Elliott Wave is helpful naturally because it gives you a context for the overall market, where we are within a certain trend. But more times than not, people who use Elliott Wave get themselves into more trouble than Elliott Wave espouses to benefit them. And what I mean by that is that they often think they see a top, a fifth wave of a fifth wave or something of that nature, when in reality it's not that nature. So if anything, I think less can be more in terms of Elliott Wave if you just have an understanding of corrective patterns, which is what we're going to discuss today, and then a trend continuation trading plan. Which you'll see here is that we're going to talk about different patterns, different what we'll call pre-trend patterns, or corrections is another name they're often called as well. And then what I like to look for as a trader myself is the point on the pattern at which I can safely enter the trade. And what I mean by safely enter doesn't mean that there's no risk, of course, but it means that a price level has broken, which validates a trend continuation move, such that when I enter, I have tight risk and a reasonable expectation for trend continuation. Another, I think, kind of helpful point here, and something that I've learned throughout the years of trading and learning these patterns, and learning, more importantly, I think, how to trade these patterns, is that we don't draw these patterns. The market does. And what I mean by that is that there is a, kind of a mass psychology behind these types of patterns that lead to the type of trend continuation that we can look for. Now, again, you guys are welcome to type questions in. We're going to address Q&A towards the end of this session. I'm going to run through everything. We're going to look at some live charts as well. But if you have questions, please don't hesitate, to type in a question so we can address it at the end, or of course to reach out to me, and you'll see my contact information again at the end of today's session. And again, I mentioned this earlier, but these patterns do develop on all time frames. In fact, I'm going to go ahead and pull up a few here. We're going to look at small time frames, hourly time frames, just to show you how some of these work out. This is Aussie dollar, which looks to have broken out of a triangle this morning. We hit 4-year lows this morning in Aussie dollar. However, if you want to look at a wider time frame, this same type of pattern, a triangle, but in a bullish formation. And please understand, a triangle is just one of the pre-trend patterns that we're going to take a look at today. Dollar peso. I'm not sure if any of you trade dollar peso, a rather interesting currency pair, especially from an intermarket analysis point of view. But we similarly just hit 2-year highs on dollar peso. And so with that, you can see here also a triangle. And again, I think it's helpful to think of that concept that we are not drawing these lines. The market gave us a triangle. It gave us this wedge-like formation. And then we saw a breakout, which has some identifiable profit targets that we can look at. But the thing I wanted to show you there is that this does happen on all time frames. You can see there, there's some other charts that we're going to look at specifically as well today. And these are not the only ones that these patterns are working on. In fact, I kind of have a dualistic mindset. What I mean by dualistic mindset is that the market is either in a trending atmosphere, impulsive, to use an Elliott wave term, meaning it's advancing the overall trend, whether that's a bullish trend or a bearish trend, or there is a disruption of the bullish or bearish trend. That disruption is what we're going to talk about today, because those are effectively the corrections or the pre-trend patterns. And the reason why, as traders who are putting our own capital at risk day in and day out, the reason why these are important is because these are the points at which risk reward is often going to be the most favorable, right? Because if there is either a trend that is impulsing right now or advancing the overall trend, or there is a correction, a correction is kind of like if you think about a train stop, right? When the train is on the tracks, it's very tough to get on the train. Some people try to, some traders try to get on the train while it's in motion, but the risk is very, very high. Because if you find yourself entering at the end of the trend before let's call it a sharp correction, one thing that we'll look at today, then that can be costly. So these sideways moves are often a place to get in to the overall trend in which you have, again, limited risk. Risk is always going to be present, but if we can limit it, that's great. And also you can have a clear idea of, okay, should the trend continue, this is the way I want to take it. So some of the real-time examples we're going to take a look at today, you see Aussie dollar and Euro pound. I showed you dollar peso as well, all in a triangle type formation. Euro pound is not in a confirmed triangle, mind you, but the concept I want you guys to know here, and I think it's important in today's environment, is that some of these, i.e. triangles, and you'll see with what we'll call a flat range, are time eaters. And what that means is that it's best for you to read a book, take your dog on a walk, go on a run, whatever you need to do. Being in these moves, being in these sideways moves, are probably not the best use of your time, your margin, or your emotions. Because as we'll see here, you can get a pre-trend pattern on top of another, what we like to call a combination correction. Those are a headache in the cleanest sense of the word. And so what we want to do is we want to be able to say, okay, I recognize the overall trend. I recognize that we're in this type of a pattern, or this type of pattern is playing out, and these are the levels at which I would like to enter should we get a breakout in the direction of the overall trend, and this is the level that invalidates my overall view, i.e. what we like to call a stop. And so what we're going to notice here is there's effectively, again, a dualistic mindset here. There's either with the trend or against the trend, or counter trend move. Basically, there's also kind of two types of counter trend moves. There's a sharp move, which we often see with dollar yen. This thing, you'll get a wash out of dollar yen, but if we don't break new lows, then it's likely just a trend continuation play. We saw this in October. Or you can get a sideways move, and I'll tell you, sideways moves often denote underlying strength. So those are very exciting. And John, thank you for that. We'll absolutely get to some real-time chart examples in just a moment. But the sideways moves are often very favorable once they break out. But if you're entering it in the middle of the pattern, as I'll show you on some charts here, we don't know when the sideways move is going to end. In fact, one pattern this year that has just been a headache among headaches. And you're going to notice some labels on my charts, guys. Those are of the Elliott wave variety. So don't feel uncomfortable with it. Basically, we're just, again, looking at the overall direction. But pound Aussie is one. Pound Aussie, I'm not sure if any of you guys trade sterling Aussie, but it's been in a massive sideways move here, possibly just breaking out. And as you'll see with today, we have a rather clean level we can look for. But the thing I want to show you is that you can see here, yes, there was money to be made. Yes, there were opportunities. But for those that are, let's say, position traders, And remember, these work on all time frames. For those of you that are position traders looking for a multiple percentage move in the direction of the overall trend, the prior trend, which is higher, this was a time eater. And what I mean by that is you can see here a lot of overlap and no real trend progression. For those of you familiar with Elliott Wave, and it's okay if you're not, that wasn't a prerequisite for this webinar. For those of you familiar with this, you can see that we might have ended a correction here, and as we'll discuss with the trading plan that I'll present to you via the presentation today, we'll look for this break here of effectively 86.50, which I think, not a trade recommendation from myself, FX Street, Daily FX, not a trade recommendation, but I think if 86.50 breaks, we're likely going to see a trend resumption that will challenge, if not break these 2014 highs. It may not be in 2014, but I would expect that to break if 86.50 breaks. All that to say, these sideways moves are something you want to be aware of, because until they break, it can be very frustrating. It can be costly. It can be time intensive, which if your margin is tied up, that's important. But these are some of the examples we'll look at. And then there are sharp corrections. We talked about yen crosses. Aussie Kiwi is another interesting one that's effectively displaying that right now. We've got a very clear level to say, okay, if this level breaks, which we're not too far away from it right now, that could present a very significant opportunity. Those of you who are unfamiliar with Elliott Wave, I'm just going to run through a quick synopsis of it. For those of you that have studied Elliott Wave, you probably think that's a joke, but what I want you guys to know is just a few things. It's not new. It's been around since the 30s, and it in fact was built off of Dow theory, a much older form of technical analysis. Some say the first form of technical analysis in the Western world. The idea here is that markets will continually follow emotional patterns, and that's what we're looking for. We're looking for pre-trend emotional patterns. The entire Elliott Wave sequence is built off of Fibonacci numbers and ratios. In fact, we'll use some Fibonacci levels here today. Pattern analysis, again, is kind of the best tool to help us. And what we're going to do today is use these patterns to help us time entries and exits. And then you'll see there the realities of the markets are hidden in plain sight. That's a fancy way of saying, listen, once you see these, once you are able to grasp these, and Yasir, we will talk about gold in just a moment. So thank you for that comment, my friend. But once you grasp these, you'll have a hard time not seeing a pre-trend pattern, whether it's a triangle, a sharp channel, or a flat sideways range. A few just comments about Elliott Wave for those of you that are just thinking about getting your hands dirty with Elliott Wave. It does not provide certainty about any specific market outcome. It's probable outcomes. You're looking for what is probable, and therefore, you'll hear me mention this throughout today's session. Whether we recognize a very clean pattern or not, risk and leverage always have to be very carefully managed. One thing that I think is very helpful to note is that different views can be profitable, and what I mean by that are different counts can be profitable. I mentioned earlier today that people often get more trouble with Elliott Wave than they are benefited by Elliott Wave. That's not always the case, and I am a huge fan of Elliott Wave, even working on my certification right now for the Chartered Elliott Wave Analyst. But the thing that people often do, and I think that's the ego getting in the way of trading, is that they always think that they're at a top. Right? I think it's very egotistical to have that type of approach. It's kind of like when you're at a party, you think this is the most important place to be in the world. No, that's just where you are right now. And so all that to say, it's important to note that just because you and I might have different Elliott Wave counts, if we both notice the overall trend is up, but we're in a corrective pattern that is correcting that uptrend, and the break of that pattern continues that uptrend, we could have different counts, meaning we think we could be in different places of the overall trend but still be profitable. And then another thing I like to look at is that Elliott Wave, and again, this isn't necessarily just an Elliott Wave webinar, but these pre-trend patterns we're talking about are in the context of Elliott Wave. I like to think of using Elliott Wave as a roadmap, right? In each trade, whether it works or not, it's just a leg of the trip. We might have a detour, so to speak, and have to take another one. A few quotes that I want to share with you guys today in terms of this, and again, this is using some of the concepts of Elliott Wave to show you these pre-trend patterns. This is a screenshot of a very famous documentary that's hard to get your hands on. The documentary is called Trader, and it that's Paul Tudor Jones in the late 80s. That's why that screenshot might look a little odd if you have not seen that documentary. But in two separate accounts, not only in that documentary, but in the interview of Market Wizards, which if you guys haven't read that, I encourage you to. He talks about Elliott Wave being attributable to his success. In a forward he wrote to a book called The Logical Trader, he talks about how it's one of the four Bibles of the business. So just a way to tell you that these patterns here are rather helpful. So here is what we're going to be looking at today. Effectively, we're going to be looking at pre-trend moves, waves 2, waves 4, and you can see that here. We'll be looking at waves 2 and 4 for recognizable patterns to join 3 and 5. Effectively, wave 1 is where we get our bearings straight, right? Trading takes patience. In fact, my colleague and friend who has done some webinars for FX Street before, Jeremy Wagner, often says, listen, the decision not to trade or not to be in the market is a decision. And that's absolutely true, because there's a lot of times we're not going to be in the market, whether it's figuring out what the corrective wave or the setup wave that we're looking at is, or whether we think that there's a basing formation and we're not quite sure. We need to have that discipline, so to speak, to say, listen, right now I'm just getting my basis for what the market is doing, the context of the market. So here's what we're going to look at today. And regardless of the chart, you guys are going to see me flip back and forth between charts and between the slides here. So again, we talked about looking at waves 2 and waves 4. Some are clean, some are not, to join the overall trend, i.e. waves 3 and waves 5. Let me just clean this up real quick. I think we're working on, as we broke a 4-year low on Aussie dollar today, a wave 5, a new leg lower. We're going to use these types of corrections to identify and get into that overall trend, right? Which going back here is lower. One thing to note there, in case you're not able to stay the entire time, the target on this triangle, which this is an ugly triangle, and it's important to note these things are not always clean. Again, their main purpose, these sideways moves, their main purpose is to eat up time, right? And so this triangle did a great job of that. This wave 4, in which you have a compressing triangle, or converging lines, you can see here. It ate up a ton of time. In fact, you can see here we kind of made our peak in the very beginning of October. We saw our breakout in the last week of November. So ate up a lot of time, and now I think we are going to take us down to 83.50. Again, not a trade recommendation for myself, FX Street, or Daily FX, but that's what we look at with these types of moves, and we'll break this down in just a moment. But the idea here, and the thing that I want to share with you, is that it takes patience, right? I mean, and that should be a good thing, right? Not always being in the market kind of gives your nerves times to catch up, all right? So here's another thing that I think is going to be helpful. I like to call it the rub. Chances are, and this goes to my earlier point about you and I might have different Elliott wave counts or a different view of where we are in the overall trend, but as long as we can identify that a correction is happening, we can still come out ahead, all right? And here's the idea. Knowing a correction is happening is helpful, because if you know to stay out while this is working out, if you remember that pound Aussie chart I showed you a little bit ago, those things are nasty, right? They eat up a lot of time. They're a bear to wrestle with. And you can get in trouble trying to force the market to get into your overall view. What we're going to look at here is objective levels for entry and exit. The short of it is we're always going to look for, in a bullish environment, higher highs, higher lows, higher highs, higher lows. In those higher low environments, the corrections we're going to talk about today, we're going to look for one of those lower highs to break in the direction of the overall trend, and then we can use a recent low as our stop, and I'll explain that with some charts here in just a moment. And you can see here there is a limited number of patterns. That's helpful. This map that I have here, I think this is helpful because once you understand these patterns clearly, it's kind of like having a "you are here" on the map. You know, there's just I think a human nature that whenever you see a picture, maybe it's a family picture, chances are the first thing you're doing is you're looking for yourself in that photo, making sure that you weren't blinking, or you had a decent smile, whatever it may be. And when the first thing you do when you look at a map is you look for, okay, where am I in relation to the overall context? And again, that's exactly what we're looking for. It's easy to identify those overall trends. Euro dollar has been down since March 8th, or May 8th, excuse me. So since May 8th, euro dollar has been dropping from 39.92. We just need to find out, okay, when is there a pre-trend pattern or a sideways or a corrective move that we can get into that trade at a good point. Of course, we always must continue to manage risk. Okay, so these are kind of the three key patterns that we're going to be taking a look at. The top one is often the sharpest, and I think that's what we're looking at possibly with euro yen. Let me go to euro yen right now. Euro yen, very, very sharp move. And what you'll notice here, guys, is I often am going to have these lines here. These lines on my chart are effectively validation points or invalidation points. It's the same either way. So when we're looking at these sharp corrections, again, euro yen, you can see here we dropped 350 pips or 360 pips from Thursday's overnight high to Sunday's opening low. Well, the question is, are we just in a correction, which is probably going to be the safe bet given the strength of this trend, or are we in something more significant? Well, based on how we're going to take a look at it today, we'll have some clean levels to say, okay, should this level break, then we have something on our hands that could give us an opportunity to take this into 150. If it doesn't break, then we can again, if you remember that slide I showed you earlier, we can let wave one play out, which again is going to be tough, but that's often what a good trader has to do. They often have to let that most confusing, most uncertain first part of a trend play out, and then quite simply know if this does reverse, there's going to be time. There's going to be opportunities for me to get in. I don't have to be the first one in the trend, and if I think I do, that's probably my ego trying to take money, trying to do more harm than good by being proved right. But what you'll see here is there's effectively three we're going to be looking at, right? There's the sharp moves here, which I think you could look at euro yen as that sharp type of move, and you can see this is a more broken down view. So this is a simplified view on the left. And you can see here a more detailed view here. A flat correction. Those are, I like to refer to those as traps. Those often trap a lot of traders. And the reason why they often trap a lot of traders, let's take a look at pound yen, is because a lot of times it's going to be these sideways moves, right? And that you get a new high or a new low or something of that nature, right? So regardless of these labels, right, you can see when we're not moving straight higher, or when we're not moving higher, these sideways moves here are rather difficult to trade, because a breakout trader who's going to have an entry above here is going to have a difficult time. So we'll talk about how this will work, and let me just share with you again, I mentioned lower highs are going to be key. The entrance point on here, go ahead and take this off, would have actually been this lower high. So maybe you would have gotten in here around 82.75, 200 pips later, see that, okay, this is looking great, and then about 100 pips from now, seeing that it's not working, and as we'll talk about trailing our stops, which is very critical with price action, we might have gotten out with a small profit, but it did not take off the same way we thought it would, and that it eventually did on this breakout here, right? Because that's the kind of move that we're looking for. This type of move here. So there can be profitable trades within these sideways moves, as long as you're managing risk. If you're not managing risk, there can be unprofitable trades in the best of trends, even trading in the direction of this trend. So these flat corrections, we'll take a look at that. And really what's going to be important to me is breaking it down. And what you'll notice here is there's effectively two levels that I'm looking to enter in on. And most of the time, you guys, if any of y'all watch that show Breaking Bad, Incredible show. Recently ended. But I like to think of I enter the trade when we break B. So breaking B in a corrective type format is what I'm looking for. That's usually that validation of the overall move. And what I mean by that is that if this is a bull market correction, so 3 waves against the trend, like in Euro Yen. Let's go back there real quick. This looks to be that type of move. So a very small A, weak B, and then a very strong move down here. Again, took out roughly 300 pips to the downside on this leg here. So yes, it's a ways to go, but it's still effectively a later but safer trade is the way I like to look at it. So again, if you've seen that show, or if you like that show, or if you've even heard of that show, Breaking Bad, you can think of breaking B is what I'm looking at to enter into the direction of the trend. Naturally, zigzags or these sharp moves here will also draw a channel, and we'll use RSI in just a moment to identify potential opportunities to enter into the trade. These sideways moves here with what I call traps often, you have to be a little bit more careful, because I showed it to you on pound yen. Often it's going to take a sub part of that move, like I showed you here, to get into that move. And effectively, I saw this as a zigzag, and then what turned out to be is that this was just a larger sideways move. There's still profitable entries within this, but you've got to be careful and you've got to manage risk. And then triangles, again, something that I think is pretty common in today's environment, mainly because you have central banks going back to a currency war type environment. You have Japan trying to completely eliminate the deflationary mindset of their residents. So they're weakening the yen via their monetary policy. You have the Swiss franc and the Swiss National Bank, which has a very important vote coming up. I think it's on Sunday, the Swiss referendum. But all that to say, you have them weakening their currency with the Euro-Swiss peg. You have the ECB possibly getting on QE. All that to say, you have triangles everywhere. Another triangle I haven't shown you guys is Euro-Pound. And it looks quite simply like we have this type of move, a triangle happening. Now, back to breaking B, it would take a break of this 77.88 to look like we're moving back to the downside. I showed you that we hit 4-year lows on Aussie dollar today. Right? And so what we did is we broke B. Right? Breaking D is not as a validating move, right? Because you might have this mislabeled. But if you have the extreme part broken of a triangle, that's often going to be your best bet. So there's 3 triangles that we have in today's environment that are to me clear as day. We had a small one here on Euro USD, but it seemed to be part of an overall move. And same thing with dollar index. It was just a smaller part of an overall move. Again, we can enter these trades. We don't know exactly how they're going to play out. Our job is to identify these patterns and find a way to enter in the direction of the overall trend while managing risk. The other one I showed you guys is dollar peso, which, my goodness, this is a 3-year triangle. And some would say longer than that. Some would call this easily, going back to 2009, a 5-year triangle, right? Given that this was the start. So you have an A, B, C, D, E. And remember that first point I mentioned, we're not drawing these lines, the market does. So we break out. Another triangle that recently broke was gold. So our friend in the room, Yasir, said, can we talk about gold? Absolutely. We had this sideways triangle here on gold. And when this 1240 broke, it gave us an opportunity to say, okay, it looks cleanly like we're moving lower, but a break of 1180 would be a clear confirmation point. We got that. We got that break of 1180, came down here to 1130, and now we're focusing on, are we going to continue making lower lows and lower highs? You can see here the level I have marked is 1255. And so should we stay below there or have another leg with RSI where we break the momentum, which RSI is kind of like price in the sense you can draw trend lines, you can do a lot of helpful things with RSI. I will often put Bollinger Bands on RSI to find out when we get some weakness there. But if we break momentum in RSI and we stay below 1255, it's possible we're still working on this move to the downside. However, should 1255 break, Yasir, that to me would be that first clear signal to show us that, quite simply, we might be done for the near term on the downside. Now, from an intermarket analysis point of view, please understand, if we do start to get a lot of strength in gold, like above 1255 and above 1300, that likely is going to mean yen will be stronger, or dollar will be a good deal weaker. So these are the triggers that I just mentioned. Feel free to take a screen grab of this, whatever you want to do. But I mentioned breaking B. The more aggressive approach you can take on a triangle against breaking D, but you're also going to be much more subject to a misinterpretation of the market. And you can see here the other ones are focusing on that B wave break, that lower high in a bull trend, or that higher low in a bear trend. In fact, let's go to oil. What you can see here is I have a higher low on U.S. oil, which is highlighted here, 73.89. Momentum looks to be stalling, but we could still move higher, right? That's why I try and stay out of that first move of the trend. It is because it's usually going to be a nastier move. But if we break this higher low, again, you could look at this from a labeling perspective as effectively A, B, possibly C here. All I know is that if we break 73.89, we're going to have a resumption of this overall trend, right? What's interesting, especially given the holiday for those in the U.S. on Monday or on Thursday, is OPEC is having a massive meeting on Thursday, which could rattle the market. They've been quoted saying, "Listen, if we do not act aggressively, oil could go down to $60 a barrel." Well, you can see there we've got a clean price to say, okay, if we break 73.89, we can focus lower. I think you have a price target before then around 67. That's going to be worth focusing on. You can see here kind of a whole cluster of support. That would be my focus if we break that level I just mentioned to you. But the idea, again, is very simple. When we have a counter trend move, we want to be able to identify an entry point, and then we can use a lower high in a bearish environment to set our stops, effectively a price action stop. Now, if this is something that you guys are working on yourself, you're not comfortable with, these are two things that helped me many years ago. First, going down to an hourly chart, trying to get comfortable with recognizing these different patterns, whether it's a sharp move in which I draw a channel on, whether it's a sideways move or a triangle. Again, I mentioned that phrase earlier. The realities of the market are often hidden in plain sight. You often have to get your mind accustomed to looking at it. And then as far as a thought process, it's often best to know what, or to think, I should say, about what shouldn't happen as opposed to what has to happen. Again, that's where a lot of traders get in trouble, is they think about what has to happen in the market. And by no means is that going to be healthy. Because if you're thinking that you can call what the market's going to do, you'll get a more, let's just say you'll often trade larger than you should. All right, so this is again what we're looking for, a clean counter trend pattern, right? Ideally, we'd like to see some Fibonacci confluence. And what I mean by Fibonacci confluence is whether it is a resistance point, whether it's a resistance point or a Fibonacci target, right? So again, these labels, you don't have to worry about these if you're not a fan of Elliott Wave. I just put them on here for those of you that are a fan of Elliott Wave. Basically, what we're looking for is more of the patterns. Is it sideways or is it sharp? And depending on that answer, we're going to have different places to enter into the direction of the trade. This is another sideways move here. And what's interesting, you can see from this, effectively from this lower high of around 59.40, we've stopped right at this 382. And that's one thing you'll often see with sideways corrections. Sideways corrections will often have a 382, sometimes a 50% retracement. The sharper corrections will often have a 618, sometimes a 786 retracement. And that's helpful to note as well. In fact, I believe that's roughly what we got here overnight, was around a 618 on euro yen. So if we break this 47.39, naturally I'll be looking next to 48.42. If we break this 618, we can go down to a smaller chart. If we break this level, we talked about channels a little bit earlier. This was a very sharp move after Kuroda spoke in the BOJ minutes last night. But if we break here, this will be moving on. Either way, this is going to be that first level of focus to get my attention back higher. And this, again, would be the trading focus. Yes, the trend has likely already gone underway, but given the strength of this trend, there's really not much saying we can't hit 150 pretty easily, unless there is a risk-off event, which, again, will manage our risk, and we might not even get into this trade if we don't hit 150. Some are saying my voice is breaking. It might be that. It might be a connection issue. I'm not 100% sure. Okay. A few other things we can look at is naturally RSI divergence. RSI divergence or a trend is often a clean say, okay, the trend is resuming, right? That's something we want to see. When you get that type of edge in RSI or break with RSI, very helpful way to note that we have trend resumption. And then next you can see here we like to trail our stops based on highs and swing lows. I know time for some questions here. So we've got probably about 3 more minutes or so to get on to questions, and just have a few more slides to go over. So what this is here, and I think this is very important, because it's very easy to say, oh, okay, patterns that happened prior to a trend, I wish that was the case. I wish that's what I was giving you. But at the same time, and I've mentioned ego before, I think that, surrendering to your ego is probably one of the most important steps you can ever make about trading. Much more important than learning Elliot way, learning how to, break down a monetary policy. It's surrendering your ego to being right, being in the market now, being at the so you could. I often say you need to have multiple ways of looking at the market, right? This is a correction. That's easy to see. The resumption of the move is no longer there. So we talked about Aussie dollar. In this overall move, you didn't have the same impulsive trend progression that we had before. Right now on euro dollar, just a sideways move. We've effectively slowed down this progress. Cable's not much different. Right, we have this sideways move here. We're kind of stuck between 57.35 and stuck between 55.80. It's helpful, though, to say, okay, what else is going on? And so what you could see here is with these, I have labels on my chart. Basically what I'm looking at here is the idea that we could have different ways of looking at it, but the price is the price. If we have a clear level, we have a point at which we can enter into the trade. And that's what we're looking at. Given the fact that the overall trend is down, I most aggressively would want to enter at 56.20, or more ideally, enter on a break here. Take out the stops that have likely been broken here, and then take that. This is my favorite quotes, and it's from Market Wizards as well, from Bruce Kovner, who's referencing the first gentleman interviewed, Michael Marcus, but willing to make mistakes regularly. There's nothing wrong with it. Michael taught me about making your best judgment, being wrong, making your next best judgment, being wrong, making your third best judgment, doubling your money. Now, not saying you'll double your money, but the quote I think is valid. And that valid point is that once you recognize these trends and where to enter in the direction of the trend, that can often give you an edge in trading. Remember, the idea here was that we thought the trend was resuming. This looked like a full trend resumption, and then we had another retest down to 81. The idea here is that we always want to be managing our risk. We always want to use these swing lows. In fact, you can see these tools here. I'm not sure what your charting package calls it. I use FXE Market Scope 2.0. We call them fractals. Kind of a misnomer, but all that to say, I use these fractals to identify price swings. And that allows me to set entries and allows me to set price action stops. And the last slide I have for you guys. And basically what I just want to do is say, these are the questions. Overall trend, I want to add B wave broken. The most aggressive trade I'd want to take is on a sharp move, has a lower high in an uptrend, has that broken. Again, it's still valid, but you might be proven wrong. You might put that quote I just shared with you guys to the test about using your best judgment being wrong, second best judgment being wrong again, third best judgment, and then being in the money. All right, with that, I'm going to open it up for questions here. We've covered a ton. That's often my greatest sin, if you will, is trying to do more than we have time for. Sure, we get to some questions. We've covered those three kind of those three key corrections. Again, effectively breaking it down to two, you have the sideways sharp, but within the sideways you have just the flat type of moves, which I think we're seeing in both euro, dollar, and cable, and then you have those triangles, like I showed you with particularly euro sterling, Aussie dollar, and longer term dollar peso. So with that, we will open it up to questions. Yasir was asking about gold a little bit earlier. And to me, the interesting thing with gold, I mentioned this quite simply, that we are able to use this concept on multiple time frames, right? And so what's often hard for people to, let's just say, sorry about that, to digest is the fact that, listen, on an hourly chart, there might be an uptrend. On a daily chart, there might be on a downtrend. On a weekly chart, there might be a correction of a very strong, longer-term uptrend. And that's kind of the view that a lot of people are getting with gold, right? And quite simply, we have had, you can see here, 3 years of a downtrend. Very, very interesting. And so with that, this has been a sharper move, naturally. I mean, we've gone from, and if my chart looks a little bit different than yours, I do have it on log scale, so it's incremental. It's incremental adjustments as per percentage moves, as opposed to as opposed to price moves. That being said, I can go off of log scale. I make it a little bit easier to read. But so with that, we're coming at an interesting point here, because should gold break higher, which given the kind of context of the overall environment, Yasir, I think it's just a matter of when it does and how aggressively it does. I mentioned earlier that kind of more aggressive, that more aggressive price that I'd be looking at of entering would be effectively this most recent lower high, which is right here at 1255. What's interesting about this is that should that happen, chances are we're going to see some weakness in the dollar, which we're just not getting yet. I showed you guys dollar peso, right? So with dollar peso, you've got a breakout of effectively a 5-year triangle. You've got GDP coming out this morning that's likely going to push this one way or the other, but given the overall trend, it looks like it's going to be higher. So we're going to have to see some levels break, I believe, on U.S. dollar before we see gold really push higher, Yasir. That's just more of an analysis point of view, but just using the price patterns that we've looked about and the different type of moves, I would like to see that 1255 break, and then additionally, the levels that I think would need to break on dollar index, this is FXCM Dow Jones dollar index, would be either, you could see here effectively this 11.3, 11.285 would be some support to break, or 11.2. But given that relationship, we're at multi-year highs on the dollar index. And because we're on multi-year highs, it's very hard for any commodity, gold, silver, oil, to do incredibly well without the dollar getting weaker. Naturally, we saw a very massive move in dollar weakness in 2008 and 2011. Obviously, later 2008, 2009 brought us that bull market, and oil dropped from 147 to 37. But all that to say, it's going to be hard to see gold really outperform to the upside without dollar strength. And I'll just do this overlay real quick of the U.S. dollar. And you can see there, when dollar bottomed in 2011, which I also have marked on that dollar peso chart, that's when gold peaked, right? And so that's 2011 there. All right. So with that, I believe that's all we have for today. I know we're out of time. I went a little bit over. I do want to wish everybody coming up the next couple of months, got the holiday season. So wherever you are, whoever you are, hope you enjoy the time with your family. Hope you're able to use some shared winnings of 2014 to spend on those you love. But I do want to thank everybody. Appreciate your time today, and I will see you guys hopefully very soon. Have a great day.